So what I want to talk about today is something that we see quite frequently, which is individuals who are attracted to a whole life insurance policy. Cash value is their goal, but they do not want to make payments for a long time. What we have specifically is an individual who has started a policy already. He's 2 years into it. He's about to start policy year 3, but the original plan was to fund his policy with $1 million total. The plan with respect to funding the policy is 4 payments of $250,000. He's already made 2 payments of $250K, and he's about to make payment number 3. So this summer, July is his policy anniversary date. Once he makes that payment in July of 2023, he will have gotten $750,000 into the policy. So he's 3/4 of the way to his goal of $1 million total. The original purpose for taking out the policy was the cash value. He was attracted to the cash value as a safe, liquid, and tax-free area to position money. He had excess funds in the bank that he wanted to shift into a whole life insurance policy. The tax benefits, he can access the cash value tax-free, provided we don't trigger a taxable event, such as cashing the policy out with a gain, triggering a modified endowment contract, loaning out the maximum amount, and then having the policy lapse, or other taxable events. I always like to add that in, that taxes can occur when accessing the cash value, because a lot of times people just hear, you can use it tax-free. Yes, you can, but the last thing anyone wants is to access the cash value thinking it's 100% tax-free, and then some left field situation hits them and they find out they have to pay taxes. Oh no, we don't want that. So he can access it tax-free. Anyway, aside from the cash value, the death benefit also has value to him. He's got 2 children, and then he owns a business. He's interested in potentially using the cash value for his business, and he might use it for real estate in the future, but his moneymaker has been his business over the years. Couple questions here that I want to raise in this video that are common for people to have. His plan originally was to fund the policy at $250,000 per year for 4 years. That's $1 million of his cash that he's moving into the policy. What happens when I stop paying? Because the product that he decided to move forward with is a 10-pay policy. What a 10-pay policy is a policy that has premiums due for 10 years. Does that mean that you have to pay into it for 10 years? No, it does not. But what happens in year 5 when the premium comes due and you don't want to pay it? Can you continue to pay it? Yes, you can. But again, what happens if you don't? So we're going to answer both of those questions. The first, what happens when I stop paying? And then 2, can I keep adding money? Then we want to look at the cash value performance. What we're going to look at, to keep it simple, is just dollar amounts. A lot of times we like to look at the internal rate of return. What we're just going to look at is on a yearly basis, how much is the cash value growing by? And then also what's the total gain? So let's call it yearly cash value growth. And then also the total gain is what we want to see. Then flexibility. What happens if I can't pay $250,000? So let's say in year 4, he can't pay the $250,000. Is he committed to that? Well, the answer is no, and I'll show you exactly why. And then lastly, we want to look at some policy loan strategies. We're going to look at a $800,000 loan for his business. We will look at this in the 4th policy year, which will be in just about a year from now. We are in June 2023. His policy anniversary date is July 2023. So July of 2023, his 3rd payment will be due. Policy year 4 will be July 2024, and that's when we're going to illustrate this $800,000 loan coming out of the policy. When we look at loans, the important question that business owners and a lot of real estate investors often ask is, what is the cash value growth? Meaning, what am I receiving from the insurance company directly compared with the cost of the loan? Meaning, how much is the insurance company giving me in dividends and interest? And how much am I paying them in loan interest? I want to see that. I don't want to just hear it should work out for my benefit. I want to see how much I'm gaining and how much I'm paying. And I want to make sure that I'm not in the red. And if I am, How long? We'll look at exactly that. So let's start off with these two questions here. We'll start with the first one. What happens when I stop paying? What we'll look at is our in-force illustration. So what you'll notice here, this illustration begins when? Is it year 1? No, it is not. Look at this. Year 2. Under the annual outlay column, do you see any funding in year 2? No. The reason why is because he's already made this payment. So he's paid year 1 and year 2. Both years have been $250,000. So on an in-force illustration, if this column is blank, that means we've already made the payment. Here's his money column, net cash value end year. Now end year is important to note because he's in June right now. His anniversary date is in July. His actual cash value today is not this 457 and change figure. It's closer to 450K. It might be a little bit less than that. And the reason why is because dividends have not been applied to the policy yet. When we look at the life insurance policy and when we receive our annual statements, what you'll find is that most insurance companies apply dividends and interest at the end of each policy year. So if we see terminology as such on an illustration, net cash value end year, we know that's what our cash value will be at the end of policy year 2. So when you start year 2 and ask, hey, why isn't my cash value what the illustration shows? Well, because we're not at the end of each year. And then as each year passes, we do want to produce a new illustration. Very important to do that. So here, the question was, what happens when I stop paying? So he's going to fund it year 3, then year 4 at $250,000. But then here, we've got years 5, 6, and 7. His annual outlay is how much? 0. He's not paying anything. Is the premium still due? Yes, it is. What is the premium? Is it $250,000? It's not. So you can see a breakdown up here. You see the full $250 going in. Here's the premium, $25,000 and change. And then we also have this renewable term rider for another $6,600 and change. Add those two together, that's his true minimum commitment. If you add those two together, what dollar amount do you get? I'll give you a hint. It's on the illustration. You don't need a calculator. You don't need to do any math. It's already done for you. This column, annual surrender. What this represents is that premium that is still due, but you're not paying it. The policy is covering this premium for you through the dividends and interest that are being produced. So it's due each year, but it's being covered internally. What to look for in these cases, what I like to look at is this. Let's start with year 5. You paid 0 in. In year 4, your cash value here is just about $979,000. You pay 0 in. The $3,100 and change premium is due. You did not pay it. The policy covered it. And your cash value still appreciated to a total of $1 million, $1,014,000. So we're still going up. And we see that continue. And we do that through year 7. Where's the rest of the illustration, right? So what we did on this illustration was illustrate what is called a reduced paid up. This is optional. It will not automatically happen. Even though we have it on the illustration, we still have to make this change in policy year 8. Year 8 is the earliest we can do it without triggering a MEC, which means modified endowment contract that will result in a taxable event with the policy. So we triggered the reduced paid up in year 8. And we can go back up to the first page. I'm going to pull up an Excel workbook in a minute here. But what you will notice is that the death benefit drops when we exercise this option. What do you notice here about the premium column, where we saw that annual surrender of $31,625, which was the base premium of $25,000 and also the term insurance rider? Do you see it anywhere here? No, it's gone. We got rid of it. So we had a 10-pay policy where premiums are due for 10 years, but there's no premium anymore. If we exercise this option, it'll kill the premium altogether. A potential drawback to some here is A, the death benefit does drop, and B, we cannot add any more money into the policy. Going back to the follow-up question we raised, which was, can I keep adding money? Well, the answer there is yes, you can. If you want to continue to pump money into the policy, you can fund up to your MEC limit of $250,000, or you could pay just the minimum premium, the $25,000 or the 31 and change with the term rider. It can be 50 grand. You can keep adding, no problem, through policy year 10. The same applies if you have a traditional policy. So if you have a whole life 100 product that allows you to make premium payments until you're 100 or indefinitely, whatever product you have, the same rules apply here, where you can continue to fund it for a long time, or you can execute a reduced paid up. The earliest is typically year 8. Once you execute that reduced paid up, you can no longer add premiums because you've eliminated the premium altogether. A benefit to the reduced paid up is it does sometimes enhance the cash value performance. It does based on the guarantees every time. And in a lot of cases, it does based on the non-guarantees as well. So let's do this. Illustrations are great, but what they don't give us is a cash value growth column and a cash value gain column side by side. So what we've got here is the illustration we just had up, but a bit easier to follow. Years 1 and 2 already happened. He's already made those payments. And by the way, the original illustration, this is almost on par with it. Year 2 on the original illustration, it showed something like 456.5 or something like that. So he's a few $100s ahead of what the original illustration showed. The dividend rate didn't change at all from when he started until now. That's a big reason why, and he's made all of his payments up front. But still, it's not under-delivering, which is often a big issue when it comes to whole life insurance products. When they're not properly designed, this is why I like the major mutuals and properly designed policies. We see more of this proof of performance and performance close to what was originally illustrated. Anyway, yearly cash value growth. This is going to isolate the net dollar amount that his policy is growing by every year. First year, it's negative $30,000. Where that comes from is the fact that he paid $250,000. He has $220,000, which if he's laser focused on the cash value, he paid $250,000 and he took a $30,000 hit. Yes, he's got the death benefit, but for an individual that expresses, I'm interested in this because of the cash value, there's the biggest drawback, the upfront hit. Year 2, he pays in $250,000. It was worth $220,000. At the end of this year, it's worth $457 and change, which means he got his full $250,000 back for year 2? No, he paid this $250,000 in and he got it back minus $13,000 and change. Worst years of a whole life insurance policy are the first 2 years. It's really the first year, but the second year often you still see some pain there. Now year 3, pays in $250,000, $457. After the payment, $711 and change, which means he got his $250,000 back plus another $4,500 for that year. The yearly cash value growth is isolating each year. So if you just ask the question, what did I grow by this year? What did I gain this year? This year, this year, this year. That's what this column displays. The column to the right, let's highlight this in yellow, total cash value gain, is a bit different. Look at year 4. This is a good way to illustrate. You're negative $21,000 and change. The reason why is because you've paid a total of $1 million and your cash value is $978 and change. That's $21,000 less than what you've paid in. That's why I'm still in the red on the total cash value gain column. However, the yearly growth in year 4 was positive because it was $711. You added $250. If you add $250 to $711, it comes out to what? 961 and change when we look at the dollar amount there. But your value is 978. So the gain is that $17,000 and change figure. That's what you received from the insurance company. So that isolates the yearly growth and also the total gain on cash value. In my experience, both business owners and real estate investors really want this information, especially if they plan on using the money. The reason why is because if I have this information, when it comes time to use the policy, now I can see exactly what the growth looks like and compare things directly. So we're going to take a look at that next, the loans that is. So we looked at all this information. Let me just hit on this point quick. Flexibility, in case you can't fund the $250,000. Remember that premium, the $25,000, and then the $6,600 term cost? He can easily pay just that if he still wanted to pay something. Even after year 4, if he said, hey, I want to keep on funding it, can he do that? The answer is yes, and we even put a couple of those illustrations together, comparing the original versus the in-force illustration. Let's look at the loan scenario. So here we go. On the left, we've got the illustration we just looked at. That's under green, where it reads policy values. Then we've got here cash value collateral loan. Now this will mimic very, very closely a direct policy loan, but we would still run that in the illustration software and provide that illustration. But this is a good means to get a quick on-the-fly scenario or answer to what the numbers will look like. Loan interest rate on his policy, still 5%. That is a variable rate. The floor is 5%. He's still at 5%. We'll check on the July rates, but it's likely going to be 5% or not that much higher. First year cash value, $220. LTV, 95% of cash value. LTV, loan to value. Whatever you have in cash value, typically you can loan about 95% of that. He's with Mass Mutual, and typically with Mass products, you can borrow a bit more than 95%. But again, 95%, this is a number I know we can put out, and it's relatively conservative. Usually it's a little bit higher than that as far as the maximum loan. But what we're going to look at here is in year 4, that $800,000 loan at 5%. So we've got the cost to borrow, but when we take a loan, look at this column. You're going to see exactly what the annual cost to borrow is, keeping the rate at 5%. Also, look at this column. Have you ever had a mortgage and wanted to know the total amount of interest you paid to the bank over time? This is going to show that, but with the insurance policy here, or with the loan scenario that we've got. And then it's right next to the total gain and yearly cash value growth. So you can directly compare it. All right, so year 4, $800,000 loan. All right. Without making any payments, what do we got? No principal payments, I should say. In this example, we'll assume interest only is paid. $800,000 loan at 5%. It's $40,000. In that year, his gain was $17,000 and change. That's a loss, meaning he's paying more in interest than what he's receiving in interest or earnings from the insurance company. Next year, gain or growth, 35 and change, interest payment, $40,000. He's still in the red, meaning he's paying more in loan interest than what his policy is growing by. And in this particular example, you see that to be the case until year 8. And that cash value jumps, doesn't it? Why does it do that? Remember that reduced paid up option? Remember when we did that? That was year 8. That's why. So what happened is we got rid of the premium. So the policy no longer had to pay for the $31,000 and change premium and term rider. It's gone. Now all dividends and interest are just kicked back into the policy, and we see the cash value growth accelerate as a result. But this example just assumes you pay loan interest forever. And you can also tally up the total gain on the policy compared to the total interest by year 10. We catch up in this case. What happens if you pay the loan? Let's assume you pay interest only for 2 years and then begin to pay it at, we'll just do $100K a year. You can do it however you want. But there we go. Pretty cool, right? So every year you're paying the interest out of pocket, and then you're also applying $100,000 per year toward the principal beginning year 7. What happens here? Well, as you chip away at the principal, you pay less in loan interest, which puts you in a positive situation earlier. If you're paying that loan down, you're going to see the growth quickly exceed the cost to borrow. And a big reason why is because you're paying loan interest on whatever the loan balance is, while you are earning dividends and interest on your full cash value. That's where people are attracted to this. And I am a fan of including the internal rate of return as well. We're just keeping this video simple and only looking at dollars. But let's wrap up with this guy. When it's repaid, the loan that is, what do we see? Well, we can see what the total growth is on the policy compared to the total interest I paid over time. You'll also find that your death benefit is restored to the same figure it would have been as if you never touched it in the first place. When a loan's outstanding, you'll notice your death benefit is collateralized dollar for dollar. I hope you enjoyed this video. Let us know if you did. Please leave a question or comment below. If you'd like to work with us, please check out our website, ibcglobalinc.com. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.